Welcome to the Techno Fundamental Report for December 21st. First of all, I'd like to wish all my clients and friends a Merry Christmas, and may we have a good year next year. I'm looking forward to it. I think we will. So let's talk about diversification. Why diversification is only required when investors do not understand what they are doing. It's a question of education. If you're a beginning investor and you really don't know what you're doing, you probably ought to do a mutual fund. So he goes on to say, he says, diversification is widely considered an investing basic. Personal finance courses teach it as a gospel. Deriding individual stocks as tantamount to casino gambling. Billionaire investor Warren Buffett famously stated that, we think diversification is a practical practice, generally makes very little sense for anyone that knows what they're doing. It is a protection against ignorance. So when I see people that are investing and they go into these broadly diversified strategies, I used to be there. I was there. I did that strategy back from 1982 to 1995. And so the problem is you get Walmart in your portfolio and then you got JCPenney and Sears. It washes it out. Now, one thing they teach us in business school is something called modern portfolio theory, which basically says at some point along this curve, you eliminate all risks that you can from diversification. So, Charlie Munger, who passed away recently, by the way, he said that this stuff just doesn't make any sense to him. And in fact, Peter Lynch says it's called diversification. So you need to be very aware of the fact that if you're going to get serious about investing, broad diversification needs to be really questioned. Now, nobody can predict interest rates, the future direction of the economy, or the stock market. Dismiss all such forecasts and concentrate on what's actually happening to the companies in which you've invested. So like in that prior slide with Charlie Munger, he said it doesn't make any sense to him because what his idea is you just invest in high quality companies and you don't, I have to have so much in oil, I have to have so much in chemicals, I have to have so much in technology. Forget about all that. You want to find the very best company. So Peter Lynch was not a big fan of forecasting. I don't think you can do it myself. Now, let's talk about the word speculation. I hear people all the time saying, I'm a long-term investor. And then I'll say, well, aren't you really speculating? Speculating comes from the root word spec, which is the same root word used for spectacle. So you're just trying to see the future. You're not trying to gamble. You're just saying, hey, this is my opinion of what the future is. So I'm of the opinion that speculation is a more honest word than I'm a long-term investor. Now, here is where we are on the recession front. The National Bureau of Economic Research has 6 indicators that they follow. However, there are 2, which is all employees, total non-farm payroll, and then we have real personal income excluding current transfer payments. Both these charts are updated for October, November. In fact, it's the latest graph. And you can see that everybody has a job. This thing's making new highs. Here we have real personal income. It's making new highs. So when everybody keeps telling me that there's doom on the horizon and that, the end of the world is at hand, we're going into a depression, I just say malarkey. Now, let's look at the indexes. NASDAQ, we got a pullback today, nothing serious. We're still in a very solid uptrend. This is totally normal. We've run up for, 9 weeks, and it just has to cool down. If it doesn't, we'll face bigger problems down the road. So this is not a bad thing. Now, here are the small caps. I want to point out the small caps. They've really taken off, which means that the market is starting to broaden out and the smaller companies are starting to perform. Now, here is the 200-day moving average for the NASDAQ and the S&P. The primary trend is up. The 200-day moving average is up in an uptrend. This looks like a bull market. Now, I wanted to go back and look at the Copic curve one more time. I pointed out over time that the Copic curve's primary objective is to tell you the market is put in a bottom. It's not telling you it's a buy signal. It's not telling you anything else other than the fact that due to time, human emotion, and price action, which all gets incorporated into the Copic curve, that 3,600 was the low. So we'll just continue to watch, but it looks like it to me. Now, on the aggression index, we're seeing a new high on this particular move. You know, we got in trouble back here in 2020, 2021, and you can see what happened. But we're in an uptrend, which means that the growth stocks are starting to lead. The market is broadening out. This is good. Volatility index, the VIX, we had a very volatile session today. And you can see here the VIX continues to be in very promising area here. If you go out through history, you know, you can see here that when you get down into these areas like this, good things happen, you know. So the VIX looks good. Now let's look at the power index, which is our way of measuring interest rates. And more importantly, the indicator is designed to say, has the Federal Reserve, have they done their thing? Are they done? And so when it gets below zero, that's what it means. It's just simply telling you that interest rates have gone up enough. Now they're going down. And it looks like to me that the worst is over for the interest rate hikes. We'll have to see. It has a lot to do with inflation. Here are the three economic indicators. You can see the 10-year Treasury yield breaking below the 200-day moving average and definite downtrend. Here we have the price of oil below the 200-day moving average, kind of getting a dead cat bouncing here. And then we have the financials, the bank stocks. With these lower interest rates, it's literally going to save the investment portfolios of these banks. So that's very good news. Now, the only negative out there, and this is just something to be aware of, this is sentiment. This is where we're measuring every week on a Thursday. AAII measures the people that in the survey, that who is bullish, who is bearish. And we've gotten kind of frothy here. This is telling me that maybe it wouldn't be a good time to be doing any buying right now. I would be more of a holder, but I'm just telling you that things are starting to look a little frothy, and the market is a contrarian animal, so just be aware of that. Now, on the mortgages, you can see what's happening here with mortgages. The 30-year mortgage broke below 7%. I'm hearing it could go as low as 4.5 to 5, which would be down in this area here. I would say that would be quite a catalyst for the economy. Now, on new highs and new lows, we're starting to see some new highs. The new highs are starting to outnumber the new lows. We had a ratio of 400 here about a week ago, somewhat of a pullback, but then we rallied again 2 days ago. But what it's saying is that the number of new highs is outnumbering the number of new lows for the first time in a long time. So let's hope and pray that this is a new bull market. I think it is. Let's just see what happens. Thank you very much.